They will say the ever bullish Tom Lee was ever bullish, but you were also right. I mean, is there anything that is going to stop stocks right now, Tom? Because they just keep going up.
Hi, Brian. How are you? Well, I think stocks are holding up because the economy's actually doing better in the face of this war. And I know it sounds counterintuitive, but part of it is the defense spending, at $30 billion a month, and it may end up being, $60 billion a month. That's actually quite stimulative to the economy. This $20 rise in oil is only adding about $12 billion a month to the household burden. So on sort of net basis, the war is actually helping earnings right now.
Yeah, and it's hard to admit this because I do know that gasoline prices for a lot of families out there are a major cost, especially with all the other inflation in the last 5 years. But with car mileage per gallon up, if you do the math, you're looking at maybe $50 to $100 per family per month in extra cost right now. Again, it's not insignificant. I want to be mindful of that. But it sounds like you're saying that is not enough to damage the economy and thus damage corporate earnings and the markets.
That's right, Brian. I mean, nobody wants the U.S. to be at war.
No.
And of course, we're caught in a fog of war. I do think one of the things we have to remember, even like going back to World War II, the stock market bottomed in May 1942, 5 months after the U.S. entered the war, but before any U.S. troops were even on the ground, either in the Pacific or in Europe. So the market does have a really good way of sort of discounting outcomes. And I think the reason it's going up is I think we're going to end up with a favorable outcome, which I can't say I know why, but that's what it looks like.
Well, and things could change, and I want to get your take on that because let's pray for peace and hope that things tone down. We did have a power poll. I wanted to hear from our viewers and all of our ex-followers and whatever about how they feel. And we asked a very simple question, Tom. It was what matters most for the markets right now? Is it the Iran war? Is it corporate earnings, which are starting to roll out? Or is it interest rates? People can vote now by clicking on the QR code. How would Tom Lee vote on that?
Well, I would say that of those three, only one can create tail events on both sides, which is the Iran war. So I think that the most important thing to watch and to really be mindful of is the war.
Okay, because are the other ones already known? Earnings for the first quarter won't be that affected because the war began basically at the beginning of March. So we only have 1 of 3 months where you've got some energy disruptions. The second quarter numbers will be slightly different. So with that in mind, how closely are you and your team going to be watching first quarter earnings versus second quarter earnings, which will maybe fully price in much of what we're seeing?
Yeah, Brian, we're going to watch both because, as you know, some groups in the S&P are going to be affected immediately by higher transport costs or availability of commodities. And so we're going to get a pretty good picture of sort of that disruption that is working its way through. And of course, that gives us a hint to the inflation shock that's coming. But all that being said, as you know, the world and the U.S. has been dealing with a series of shocks over the last 5 years. So in some ways, I'm not saying the market's becoming desensitized to it, but it's learning to not go into a full-blown panic.
And we're going to wrap it up, Tom. I think you still have your 7,700 price target on the S&P and some individual names. You got the One Oak, Texas Pacific Land, Quanta. It sounds like you're all in on the energy expansion and growth story.
Yes, and I think it's highlighting an important theme over the last few years, which is that every country wants 3 types of security. They want energy security, they want sovereign security, and they want cybersecurity. So I think all of those are going to be good areas for where spending grows and stocks should do pretty well.